Okay, it looks like most everyone has arrived, so let's go ahead and get started. Welcome to Mapping Out Your Pension Plan's Future, How Funding Relief MAP 21 Affects Your Plan Financially. My name is Debbie Breda, and I will be your moderator throughout today's webinar. I'd like to take a brief moment to introduce to you the head actuary here at Atessa Benefits, Mr. Matt Avery. Matt is an enrolled actuary under ERISA, as well as a fellow of the Society of Actuaries, and a member of the American Academy of Actuaries. Matt has been a consulting actuary now for over 10 years and has extensive experience in pension plan design and actuarial modeling for a wide variety of clients. Now, before we get started, I'd like to go over a few logistics. Today's webinar is being recorded, so your phones have been automatically muted. If you have any questions as we go along, we encourage you to ask them at any time. Simply type your question into the question box on the GoToWebinar control panel and hit submit. We'll attempt to address all of your questions, time permitting, throughout the presentation. If you cannot see the full GoToWebinar control panel, simply click on the arrow at the top of the screen and the panel will appear. Again, I'd like to thank you all for taking the time out of your busy schedules to join us today. I hope you find this webinar to be both useful and informative. Now, without further ado, here's Matt.
Okay, thanks, Debbie, and thanks to everyone for attending today's webinar. We have the webinar scheduled for 60 minutes, but we'll probably only go about 35 minutes for the actual formal presentation with time for questions throughout and at the end. And also, as Debbie mentioned, feel free to submit any questions in the question box as they come up and we'll address them. Let's go ahead and get started. Okay, so I have the agenda for the presentation here. First, we're going to go over a broad overview of what MAP 21 is. Now, as some of you may know, MAP 21 stands for Moving Ahead for Progress in the 21st Century. I'm going to talk about what that funding relief effect is going to be and how it's going to affect the next several years. And then we're going to talk about the increases that are upcoming to PBGC premiums with the new laws that were put into place. I'll very briefly touch on some of the other impacts that the new law has on pension plans. And then finally, we're going to walk through a case study where I show you some live projections on how the new laws will affect your pension plan's cost and also the financial reporting, and really as a plan sponsor, how you can better plan for your plan's future. So the Pension Protection Act of 2006 requires DB plans to use market interest rates to determine plan liabilities. Now, that was quite a change from prior to PPA, where plan sponsors could select a flat rate to value liabilities, and that flat rate was generally based on the long-term expected rate of return on assets. And just so we're on the same page, when we talk about interest rates and liabilities, they have an inverse relationship. So lower interest rates mean higher liabilities and vice versa. Now, most plan sponsors, when PPA came along, chose to use the segment rate to value liabilities as opposed to what was called the corporate bond yield curve. And if you recall, segment rates are really split into three buckets, and they're based on when liabilities are expected to be paid. So the first segment rate values liabilities paid within the first 5 years. The second segment rate values benefits paid in years 5 through 20. And finally, the third segment rate values benefits paid after years 20 and beyond. And because segment rates are a 24-month moving average of those current corporate bond rates, that really allowed plan sponsors to sort of smooth out these extensive decreases we've seen in interest rates over the last several years. So what did MAP 21 do? It certainly allows you to still use the segment rates to value liabilities, but it provides relief by restricting what those interest rates can be. So, and also in a high interest rate environment, MAP 21 would also restrict the interest rates that you would use to the highest amount. And one other thing I want to mention is that MAP 21 is actually optional, or the funding relief is optional for 2012, but will be required for 2013 and beyond. How does it work? Well, first, the new laws define that we look at a 25-year average of spot interest rates. And then what we do is we set a floor or a ceiling to that 25-year average based on the year that the valuation is performed. And then when that comparison is done, the final thing that we do is we compare those segment rates to whatever that adjusted 25-year average rate is. And I'll give you an example of how that works a little bit later. But I put a chart in here to show you what those percentages of those ceilings and floors are for the next several years. So you can see, for example, for 2012, the floor is 90% and that ceiling is 110%. And again, as I show on the chart here, we do show the maximum percentages. But however, in today's low interest rate environment, we don't expect those will really come into play anytime soon. And finally, I just wanted to comment on the trend of the table. You can see that those percentages in the minimum column are decreasing, and at 2015 and beyond, that floor percentage is 70%. And really, what that tells us is eventually that the relief that MAP 21 gave us is going to phase out, and we'll be back to valuing plans using the current segment rates in effect at that time. And really, what that means is that this relief is only temporary, so we have to consider how we're going to plan for the future in terms of the relief not applying forever. Let me give you a very quick example of what this all means in English here. Today, as I mentioned, the 25-year average, or actually the first segment rate, let me give you an example, is for 2012 is 2%. And let's say the 25-year average of the short-term spot rates is 6%. So the first thing we would do is we would apply that 90% minimum to the 6% 25-year average, giving us an estimated floor of 5.4%. And then we would compare that first segment rate of 2% to that 5.4%. And as you can see, that's a pretty big increase in segment rates for that first segment rate. And as a result, we're going to see a pretty large decrease in liabilities. Now, as some of you may know, the IRS actually released what those actual 25-year average rates for 2012 will be. They released them last week. So here I show a graph of what the impact of relief is going to have in terms of interest rates. And what I've done is we've projected what we think those estimated rates are going to look like in the next several years through 2017. And to keep this simple, I show the graph in terms of what's called an effective interest rate. And really what that is it's a blended weighted average of the three segment rates. And as you may recall, that's actually shown in your valuation reports that you receive from your actuary. But to keep this discussion simple, I didn't want to show three different segment rates and have a bunch of lines pointed everywhere. So what we can tell from this graph is, the red line shows what we estimate the future effective interest rates would be before any relief. And then this blue line shows what that effective interest rate will be after any relief. So, as you can see for 2011, we're starting off at the same spot because the relief doesn't apply for 2011 plan years. And then as we look to 2012, you can see that our estimated effective rate prior to any relief was about 5.4%. But once we apply the relief, it was about 6.7 or 6.6%. So as you can see, that's a pretty big jump in the effective rate. And if we were to look at in terms of what that would mean in liabilities, I think we would see this graph flip, meaning that the liabilities would go drastically down for the first year and then phase on to where once we get in 2017 and beyond, we expect the liabilities pre and post relief to be essentially the same. All right, so we've talked about where this funding relief applies. Let's talk very briefly about where the relief does not apply. The MAP 21 relief does not apply to maximum deductible contributions under Internal Revenue Code Section 404. Plan lump sum calculations under IRC Section 417 are also unchanged. Excess asset calculations for any transfers to retiree health plans will not be affected. And then, as we'll discuss a little bit later, the liability for PBGC variable rate premiums does not use any relief. And finally, I mentioned there are PBGC reportable events. Any liability used to determine that amount will not be considered using any relief. And one of those issues that may come up is anybody who funds are planned to avoid the 4010 filing may have to consider funding to 80% or more absent of any relief, which is really where we were before the MAP 21 came into effect. All right, so let's talk about how MAP 21 will increase PBGC premiums. As you know, there are two parts to the PBGC premium calculation for all pension plans. And the first part is the flat rate premium, which is based solely on our participant counts. And the second part is the variable rate premium, which has to do with the level of unfunded vested benefits in the plan. So currently in 2012, our flat rate premium is $35 per participant. And beginning in 2013, it will increase to $42. And then in 2014 and beyond, we're looking at an increase of another $7 to $49 per participant. And prior, let me just discuss, prior to any relief, there was no inflationary increases built into the dollar flat rate premium amount, but MAP 21 actually specifically wrote it in the law that we could see further inflation increases after 2014, and they're going to provide guidance on how exactly that may apply. The second piece of the PBGC premium is what's called the variable rate premium, and it's currently 0.9% of your unfunded vested liabilities. Let me give you a very brief example of that. If your plan's vested liabilities are $10,000 and your assets are $8,000, you have a $2,000 unfunded vested benefit balance, and your variable rate premium in that case would be $18. So as I show here in the chart, the variable rate premium is showing very great increases in 2014 to from 0.9% to 1.3%, and then again in 2015 to 1.8%. And also, in addition to the flat rate premium, there is an inflation increase that will be built in after 2015. But really, what's the story here that tells us that we're going to see large increases to PBGC premiums, and certainly plans that are largely unfunded are going to see much larger increases to their premiums. If we're looking out to 2015 and beyond, I mean, basically that piece of the premium calculation has doubled. So that's certainly something, as a plan sponsor, we want to be prepared for. And if we're looking at large premiums, how are we going to plan for those increases? And then very briefly, I'm going to go through some other additional effects here that MAP 21 will have on pension plans. For those of you who may be familiar with the annual funding notice that's sent out to plan participants every April, the annual funding notice is actually now required to have additional statements of disclosures, one of which talks about using modified interest rates. And a second, really as a result of that, is a statement that discusses that plan sponsors may contribute less to a pension plan as a result of using modified interest rates and missed relief. They do discuss that there will be a table that they want us to show on the annual funding notice that will describe the pre and post funding requirements for MAP 21. But really, as a result of all this, the Department of Labor did actually specifically say in the guidance that they would issue a model notice for us to use. So nothing for us to worry in terms of what that notice actually has to physically say. But I think more importantly, as a plan sponsor, for those of you that have participants that seem to be concerned when they receive this, I think the annual funding notice right now has plan termination language in there, and certainly plan participants, I think when they see that, they have seen that it becomes a little concerning to them, like my benefit might not be available, or they're going to stop my benefit, or I'm not going to get my benefit, or whatever the case may be. And I think as a plan sponsor, adding these additional disclosures certainly is not going to help that case, but really we should be thinking about what can we be doing to communicate with our participants to ease their mind and make sure that they understand that this is just what's required by law to be shown. We have our clients here. We actually recommend that they send a cover letter in addition to the annual funding notice that basically describes that this notice is model language that's required, and the actual impacts of the language have no impact on them in terms of the pension plan. And then lastly, I mentioned very briefly, and I'm not going to go through this in the presentation, but that the MAP 21 effects now also allow excess asset transfers to fund retiree group term life insurance.
Okay, I know we've covered a lot of information, so before we start looking at the case study featuring our app projection model, we're going to conduct a brief survey to get your opinion on the funding relief so far. Now, given that MAP 21 funding relief is optional for 2012 only, will you elect to use the relief for 2012 or defer it to 2013? And the poll is now open, so please take a moment to select one of the three options on your screen, and we'll give everyone a minute or two to respond.
Okay, just another few seconds here. It looks like almost everybody's voted. Okay, I'm going to go ahead and close the poll and share the results. And very interesting, we see that most people at this point are unsure if they're going to apply the relief, and that's interesting news. I think certainly I was expecting to see that more people had, in fact, decided that certainly they were all going to apply the relief. And I think if you're unsure, it's probably a good thing that you're having discussions with your actuary and talking about whether or not it makes sense to apply it this year, and maybe it's not necessary, and maybe you're still focusing on funding the plan as scheduled before the relief was applied. So certainly that's we have a couple clients here that are actually, we're going through those very discussions with them, that it's not a given that just because the relief is there that we're going to use it. So that's good. Okay, so now we're going to talk about our case study. And I wanted to give you a little background information on this case study for this sample XYZ Corporation that sponsors the XYZ Corporation Pension Plan. And this plan is frozen to new participants and also has been frozen for future benefit accruals. And right now, the main goal of the plan sponsor is to, prior to any relief, was to maintain that 80% funding ratio, which, as you know, are assets over liabilities. And the plan has 400 participants, and I just show that a few other assumptions that they're using. They were using the PPA segment rates as opposed to the corporate bond yield curve. In our projections, we're projecting an annual interest rate, annual investment return of 5%, and then we have our financial accounting disclosure assumptions of 4.5% and expected return on assets of 5.5%. Okay, so what I have here is I have a picture of our Atessa pension projection model, or as we call it, app. And what this allows us to do with our clients is discuss how the future is going to look based on infinite amounts of changes that can happen with any given plan. And I'm going to be discussing this for the next several minutes here. And I'm going to show you how basically changes to the relief, as well as changes to investment returns, potentially putting in additional contributions, and any other changes to assumptions may impact this sample plan going forward. So let me give you an example. Let me give you an idea of what these pictures are showing here. This bottom graph that I'm pointing to right now has our assets and liabilities for this pension plan. So this green bar here has the funding target, or our PPA liability, and then this gray bar shows our pension projected benefit obligation, or our FAS PBO. And then we show two lines there, the red line being our trust or market value of assets at any given year, as well as our smooth or actuarial value of assets. So then, based on our assets and liabilities, any results of any assets and liability calculations define what we have to contribute, and that's what this top graph tells us here. So this left y-axis bar here attributes dollar amounts, and as I'll show in a moment, this right y-axis bar attributes to our funding percentage. So this green bar here is, as a result of our assets and liabilities, our minimum required contribution under ERISA, and this gray bar represents our financial accounting expense. And as you can see, we project that for several years. And I also show a flat 80% dotted black line here. And as most of you know, under PPA, there's certain potential problems and issues that are a result of going below 80% funded. So I show our sample pension plan's projected funding percentage. And you can't see it right now, but there's actually two lines being shown here. The red line that's covering up the line below it is the AFTAP or funding percentage without any relief. And then, as I'll show in a moment, when we apply relief to this plan, you'll see a blue line that shows the funding percentage including relief. And that's why you can see two percentages there on the top and the bottom. So what this picture allows us to do is to modify future investment returns and talk to our clients about how additional contributions to the plan now or later may make sense in terms of funding your plan, as well as avoiding future risks that you might have, such as going below 80% funded or facing really large contributions or significant pension expense in the future. So let's talk very quickly about what our results are for this valuation for 2012 prior to any funding relief. As you can see, I show this bottom box here shows what these actual numbers translate to in terms of dollar amounts. And I show their total here of these. It's really 6 data points, 2012, and then a 5-year projection of 2013 through 2017. I have this alternative box, which is set right now to show what these totals are. And as you'll see in a moment, when we turn on the funding relief, it allows us to show what the difference will be. So for 2012, we're looking at, for this plan, a minimum contribution of about $1.3 million, a financial accounting expense of $935,000, and then PBGC premiums of $73,000. So now we'll look at what happens when I apply funding relief. So as you can see, I flip the switch, and as I mentioned before, this blue funding percentage line is our funding percentage or AFTAP after relief is applied. And as you can see for 2012, prior to any relief, they were right at that 80% level, but right after relief, they jumped right up to 90%. And I want to emphasize the reason why we show these two lines, I hinted at it before, but the idea that we've talked about certain liability calculations that do not affect any relief, and one of them that we need to consider is any PBGC reportable event liability. And certainly any of you that are out there that are funding your plan trying to avoid having to go below 80% prior to any relief, whether it be to avoid at risk or to avoid having to do a 4010 filing, this will still apply if you're looking at a 4010 filing. So as a plan sponsor, we need to be considering what the impact of our plan will be without any relief, even though we know we're going to apply the relief in certainly for 2013 and beyond, and whether or not it's optional for whether or not you decide to use it, since it's optional for 2012. So again, as I mentioned, the funding percentage increased from 80 to 90% as we elected relief, and that should be no surprise, as the impact of the interest rates was quite significant. The contribution amount went down a little over $500,000, so from $1.3 million to about a little less than $800,000 there. And our FAS expense actually increased from $935 to $941, so ever so slightly. And you're probably asking, why would my pension expense increase if I'm applying relief? And the reason for this is, as some of you may know, one of the components of my financial expense is what I expect my assets to return. And that component offsets the rest of the components. And when we're talking about funding relief, we're talking about contributing less. So unless you plan on contributing the same amount pre and post relief, if your goal as a plan sponsor is to fund the minimum, the financial accounting expense impact you have will be greater, because that expected return on asset offset is now higher, and if the offset's higher, the rest of the components are more affected. And then I finally mentioned that the PBGC premium, as we discussed, for 2012, there's no impact. So as you can see, it stayed at $73,000. So let's talk, now that we've talked about any of the options in 2012, let's talk about how this relief will affect the rest of this projection period. And again, as I mentioned, we have 6 periods of data here. We have the 2012 plan year and then 2013 and beyond. And I'll very quickly just show what the picture looked like again before relief, so we can we can see that our totals match up here. And then once we apply a relief, you can see what this means in terms of a 6-year projection to our cost. So our minimum required went down quite a bit, and that should be no surprise, as the relief impact for those first few years is going to be very significant on our significant reduction on our liabilities and also on our cash contribution requirements. So over this 6-year period, we're seeing a 26% decrease, or almost $2.4 million, to our minimum required. And then, as I mentioned before, with contributing less, we're going to see our financial accounting expense increase. And over this 6-year period, we're seeing about a 9% increase, or almost $500,000 there. So certainly something for plan sponsors who deal a lot with the financial statements to consider is that if for your pension plan you're only going to contribute the minimum, given this relief, we're got to be prepared for increases to our financial accounting expense. And then, this should come as no surprise, but the number's still big. Is the increase on PBGC premiums for the projection period is about 35%, or $250,000. Now certainly that's a large increase, but in terms of magnitude for some of these other numbers, it's not a huge number, but certainly not fun to have to swallow getting ready to pay an additional 35% of planned premiums to this point. And so this model allows me to have discussions with clients on how the relief is going to impact their plan and what it's going to mean in terms of future contributions and future expense, and are there any things we can do as a plan sponsor to help reduce some of those risks, or what's the likelihood that my funding target, absent any relief, is going to go below 80%. And but the other important thing that we show and we emphasize when we have these discussions with our clients is I have a flat 5% investment return assumption here, and I think anybody would clearly agree that we're not going to achieve 5% every single year. We don't know what that return is going to be. So certainly, what are we doing to plan for variance in returns? I think we can vary the inputs here and show what impacts to the investment return will have in future years. So, for example, if 2012, because it's an election year, if we see some sort of decrease in assets like we did in 2008, could the investment return go down, and maybe over the course of the year we see a 0% return? And then maybe 2013 recovers quite nicely and we see an 8% return. And then in 2014 maybe we see 6% and 6% for the rest, and so on. And this, when I'm having these discussions with my clients, the CFO likes to be involved, because they say, okay, here's what we expect, given our asset portfolio, here's what we expect our assets to return. But really the biggest and most important thing we can understand here is that what's it going to be in worst case scenario, and what's it going to be in a best case scenario, and then helping define what that means in terms of my cost in the future, so I can be really prepared to what that means. And then the other thing I want to mention is that we use this a lot with our clients, especially now with PPA being really in full effect, is the idea that if your goal, as this client's was, to keep your plan from going below 80%, as you can see for 2012, given this 0% asset return, they got a long way to go. So they might have to contribute something like $500,000, and that doesn't do much. That brings them up a little bit. So maybe we're talking about $1.5 million, and that brings us close. So maybe we're looking at $2 million. Oops, that was $20 million. There we go. So $2 million in this case would get us to 80%. But as you can see, that doesn't help them for 2014. So these are some of the discussions that we start to have is what do we need to be prepared for above my minimum required in the future to avoid going below 80 if that's one of my goals as a plan sponsor. Okay, I'm going to skip ahead a few slides here. We've covered these in terms of the model. So I want to go over some other considerations for XYZ Company's pension plan. And really, as a plan sponsor, this is something I really encourage you to be thinking about as this relief has now taken effect, and we're looking for several years of being able to apply this relief. And it's what other options could I be thinking about in terms of my pension plan? Now, certainly, one of the reasons this relief was written was because the option that plan sponsors can use those savings outside of that plan. Actually, if you read the regs, the rules were pretty clear on why this relief was given was because they want plan sponsors to contribute less and therefore deduct less from the taxes to increase the IRS's taxable income. Seems sort of interesting, but that's actually specifically stated in there. But the idea that we could use the savings outside of the plan to maybe help put money in other parts of our business, whether that be, helping with other, increasing our employee salaries, research and development, whatever that may be, that's certainly an option. As we hinted on earlier with the poll, we talked about the idea of whether or not plan sponsors will use this. And certainly for 2012, many people said they were unsure, and that's one of the things that we're having discussions with our clients on, is the idea that, we've had this budget for the 2012 year, and we had this intact, and now this relief came along, and we're not required to use it. So if we're committed to funding the pension plan, let's think about keeping that money involved in there and trying to get to a better funding percentage sooner, as opposed to taking the passive strategy of only funding what's required and really then delaying the problem of being underfunded well in the future in the next several years. I list the third option there of changing investment allocations. I'm not sure I would recommend this, but certainly, I think plan sponsors are having discussions about, now that we have this 5 or 6 year window of relief, do we want to think about de-risking our assets and contributing more and trying to get to a more stable asset portfolio that goes along with our liabilities? Or, I'm not sure I've heard these conversations, but are plan sponsors thinking about increasing the equity risk in their portfolio to try to gain the market? And then finally, as I mentioned, in the model, we talked about maintaining that funding ratio, maintaining that 80% funding ratio, ignoring MAP 21. I think this is, for some of you that are looking to avoid some of those other potential problems that PPA may have, and certainly the 4010 filing is one of them, trying to maintain that 80% without relief is very critical in that point. But really, the overall goal and theme here that I'm emphasizing is that it's so important, now that we know this relief is here, and now that we know that we have several years to plan ahead for it, we need to plan ahead to make sure we take full advantage. Have you prepared on how you're going to use this relief? Have you thought about how you're going to contribute for the next several years, or are you just waiting for what that minimum calculation is so you can just put in the minimum? Have you thought about the impact it's going to have on your financial statements, and are we prepared for those increases if we're only contributing the minimum? And certainly, are we prepared for the large increases to PBGC premiums, and have we thought about budgeting for those?
Okay, well that concludes our formal presentation, but before we close our agenda for today, I'd like to take a moment to address a few questions that came through during the webinar. So Matt, can you please explain the 80% funded ratio without relief to avoid PBGC filings?
Yeah, that really is, it goes back to when we talked about the actuary is going to have to be giving you two funding liabilities. There's the MAP 21 relief liability and then the non-relief liability. And in terms of what we define as what's required to be funded into your plan, the MAP 21 liability is how that's going to apply. But certainly the non-MAP 21 liability, that when we compare that to our assets, if that value is less than 80%, and we're not prepared for that, we may be subject to a 4010 filing with the PBGC. And I know I have a lot of clients that they want to do everything they can to avoid that, because it's purely just showing the PBGC more information about your plan, and I think that's something that most plan sponsors don't want to do unless they absolutely have to. So good question there.
Okay, one final question. Can we opt out of the relief for funding and PBGC premium increases?
That's a good question. Unfortunately, the only year that we can opt out of any relief is 2012 with a simple election letter to your actuary, which I'm sure your actuary can help you do that. But as I mentioned before, the PBGC premium increases do not affect 2012. So as we look forward to 2013 and beyond, when those increases first come into play, unfortunately we cannot opt out of those. They are required, and that's something that's a plan sponsor that we have to be prepared for. But another good question. Looks like we have no more. Okay. Any last questions? Well, okay. Thank you very much. I wanted to just mention that I have my contact information shown here, and also our website is listed as well. If you have any more questions, feel free to contact me after today's presentation, whether they be general questions about MAP 21 or specifically about your plan. And also, I'd be happy to give you a free demonstration. Our app model allows me to put in your plan's information that I can get from your 5500, or certainly if you want to provide me an evaluation report, I can input the information and give you a free, complimentary demonstration of what your future is going to look like in the next several years. And the demonstration can be done very quickly over the phone. It takes about 15 minutes, and we can use our GoToWebinar or GoToMeeting software that we're using for this call. I also want to mention I'm going to be emailing you today's presentation, so if you want to look at that, look back on any of the discussions we've had, and certainly that will be in your inbox, and we're also going to post it to our website. So with that said, that's going to end today's webinar. I want to thank you so much for attending. And again, please let us know if we can be of any help or give you any advice in the future. Thanks so much.